Hello everybody, welcome to Bursa Young Investor Club webinar number 6, how to invest in cyclical stock. I want to take this opportunity to thank everybody for spending your time this evening. And today we have an amazing turnout, and as of now we are almost full. Well, before I proceed further, just want to check if you can hear me clearly. On your screen there should be an control panel for the webinar. So on the control panel, if you can hear me clearly, could you please click raise the hand button? If you can hear me clearly, could you please click raise the hand button? Okay, I'm seeing half of you raising hand, the other half. If you can hear me clearly, could you please click raise the hand button on the control panel? Okay, fantastic. You may put down your hands now. Now today our topic is on how to invest in cyclical stocks. And you learn what are the characteristics of cyclical stock and what are strategies to go around it and what are the risk to reward to invest in a cyclical stock. Now, this webinar is brought to you by Bursa Malaysia, and as a disclaimer, all the case studies or companies that we study in this webinar is only for educational purpose only, and in no way that we give you any buy or sell recommendation for any stocks. So it's only used for case study only. So if you decide to buy any stock out of this webinar, you must understand that you do it at your own financial risk. Okay, and we, as you know, this is a series of webinar. Today we're on the number 6, how to invest in cyclical stock, and previously we have how to invest in REITs, how to read financial statements, how to invest in growth stock, and then subsequently we also have how to invest in value stock, how to invest in turnaround stock, how to identify a sunset stock, and stuff like this. So if you complete all these 10 series, you would be a fine investor, I suppose. So, well, let me introduce the speaker today, and he's none other than PC Wong, and he has 20 over years experience in corporate, and he is also author of 2 famous books, and he's now a full-time investor and author and trainer. As you know, now the webinar today consists of 2 segments. The first segment is half an hour content, and subsequently there will be a Q&A session. So without further ado, let's hand it over to you, PC.
Hi.
Do you have a control?
Good evening, everyone.
Let me share the screen to you, okay? Just give me a minute. I'm making you the presenter now.
Okay. Yep.
Alright, we are at your slide now.
Yeah. Okay.
Yeah, let me turn off my webcam in the meanwhile.
Yeah. Yeah.
Yeah, go ahead.
Okay. Good evening, everyone. Thank you for tuning in. So today we are going to talk about cyclical stocks. But what is a cyclical stock? Understand the characteristics of cyclical stocks. Learn the risks and rewards of investing in cyclical stocks. Learn how to identify cyclical stocks, and learn the strategies to invest in cyclical stocks. Now, what is such a stock actually? Now, a cyclical stock is a stock whose share price is likely to be affected by the ups and downs of an economic or commodity cycle, which means the stock price will have a tendency to follow in tandem with the cycle, rising when the cycle is on an uptrend and falling when the cycle is on a downtrend. So this is normally very true, okay, for those stocks that are very related to consumption, okay, and we will look at the characteristics of a cyclical stocks. Now, that stock is likely to be influenced by the following: the expansion and contraction of an economic cycle, meaning if the economy is on an expansionary period, okay, the stock is likely to gain in price, and during a contraction, it's likely to fall in price. Seasonal demand related to festive or holiday season. So some stocks would actually rise in price during a festive or holiday season. I will share with you some examples afterwards, okay? Or seasonal weather conditions, which normally will affect agriculture crops, okay? And this means the plantations. And also the boom and bust of a commodity cycle due to supply overtaking demand. Now, boom and bust cycles are normally more man-made, okay, than occurring as through nature, okay? Because normally during a boom cycle, people will do a lot of investment, taking in more debts, okay, and then expanding the production. But there will come a time where the supply will just be too much, okay, because everyone is riding on the same cycle. And therefore, with the price being pressured due to oversupply, you can see the stocks of those companies starts to fall as well. So these are actually man-made boom and bust cycles, and they are very common in the raw materials kind of economy. Okay, cyclical stocks normally perform badly versus defensive stocks during a downturn, but in an upturn may outperform a defensive stock by a wide margin. So it also correlates with the disposable income of the consumer, which rises in an upturn and become restricted in a downturn. Yeah. So during the upturn, normally the economy is booming and the consumer would likely to have a gain in wages and therefore able to consume more. So during a downturn, some consumers may become unemployable. Okay, they are left off, they are laid off. Okay, and therefore they have no means of income, and therefore consumption will actually be restricted. So most cyclical stocks are typically related to companies which sell discretionary products or services. Okay, discretionary here means things that are not a necessity to our daily consumption. Okay, things like rice, things like water, okay, gas. These are the things that we require, okay, to consume in order to, for example, electricity. Okay, we need it to light up our house. Okay, for our equipment. Okay, then rice, because we consume it, is our staple. Okay, so discretionary products are normally things that we spend when we have extra income. Okay, such as luxury goods. Okay, or to travel and also fine dining and such. Yeah, so companies involved in the development of high-end properties can also be cyclical in nature, as it correlates with the disposable income of the consumer. Okay, so if those companies that are involved in luxurious properties, okay, in a downturn, they would be the first hit, because people just would not want to invest or purchase high-end properties, okay, where they foresee that the economy is going to be weak moving forward for the next 2 or 3 years, and therefore they would not have that kind of market for the property that they buy, especially in terms of rental, okay, or in terms of flipping the property. Yeah. So seasonal weather patterns can also result in certain agricultural companies exhibiting a cyclical behavior. Okay, because if let's say there's a seasonal pattern like El Nino, it could influence, okay, the price of the commodity due to poor harvest and such. Now, overmining and investment into development and production of raw materials can also result in man-made cycles, often called the boom and bust cycle, okay, as I've explained just now. Now, the risk of investing in a cyclical stock. The share price could lose value at a much faster rate than a defensive stock in an economic downturn. Now, this is the risk that you need to be aware of, because they by nature would rise faster in an upturn, but in a downturn, the same would actually apply on the opposite sides of things, okay, which means it will actually, the share price will actually lose its value much faster. Okay, in an extended recession, the share price could be depressed for a longer duration. Now, normally recession, it depends, okay. Some companies will actually recover after the recession, okay, but some will never recover. Okay, that's why, for example, the worst the worst recession, I think in Malaysia, I think it's not really the 2008, 2009 global financial crisis, although it impacted us quite badly. But I think the worst one that we had was actually the 97, 98 period. Okay, at that time, soon after that period, a lot of companies were either declared bankruptcy or they were under PN4. Okay, so a lot of them lose their value. Okay, some will eventually lose their listing status as well, lost their listing status as well. So holding a stock at a depressed price could be an opportunity cost, because if you hold it for too long, you know, that money could have been worth something to invest in another company which actually offers better return. Okay, so companies which are over leveraged could face financial challenge if the economy remains in recession for an extended period. Now, this is what I mean. Just before the Asia financial crisis in 1997, 98, a lot of the companies were actually borrowing a lot of money, okay, to expand because of the booming period just before the crash. Okay, so when the crisis struck, okay, a lot of the companies suddenly have tremendous amounts of debt to pay, because during that early part of the cycle, I think the bank lending rate actually went up as high as, I think, 12 or 13%, and therefore companies suddenly face a lot of financial pressure. That's why a lot of them went bust. Okay, so it is therefore prudent that you select cyclical stocks of companies which are financially sound and able to survive through the hard times. So you really have to do your due diligence and select companies which have the financial strength to weather tough times. Because if you select companies based on hearsay without really doing your own due diligence as to the strength of a company, what you will have eventually in a extended period of recession, that company may not survive at all. So that's why if you want to invest in this kind of stocks, you need to really do your due diligence, check the study the balance sheet, make sure the company has the financial strength to survive. Otherwise, okay, you will have tremendous loss of opportunity cost, or worse, okay, that company might wind up in a bankruptcy. Now, the rewards of investing, of course, the share price could potentially rise at a much faster rate than the defensive stock. Okay, the company could go through a period of rapid expansion during an economy upcycle, therefore boosting its revenue, net profit, and equity to deliver rapid share price appreciation. And normally during this stage, okay, if you are bought at the early stage, okay, of the upcycle, then that company would continue to boost its revenue, and you will see expanded net profit and equity, and this will drive the share price even to much higher levels. Okay, so normally such rise could be in the multiples of its lows as the trial of an economic down cycle. Normally, economic cycle we have ups and downs. The most bottom part of the economic cycle is called the trial of the economic cycle. Yeah, at the top normally is called the peak. So this is an example of a cyclical stocks versus a defensive stock. Okay, here I use Padini Holdings. Okay, because it is a retail stock, and being a retail stock is highly dependent on consumers' consumption. Okay, it requires consumer to buy its products so that it's able to generate profit. And here, as a defensive stock, I use Axis REIT. Okay, because it is stable. It doesn't fluctuate so much. Okay, and it has very, very good dividends. Dividends yields actually much higher than Padini Holdings. Okay, now here, if we look at both, since reaching the bottom at 36 cents in 2008, excluding dividends, Padini Holdings has gained 941.7% at 18 July 2017. So if you are looking at it from 2008 to 2017, that's about 9 years. So if you hold cyclical stocks over a long period of time, okay, the return can be quite massive. Here, you know, if you even it out, you know, it's almost like 100% gain every year, okay? But if you look at exits, excluding dividend, the stock just gained 226%. But its dividend payout is also equal to about 100% of its share price. So net off is still about 300%, which being defensive still falls short of that what Padini Holdings have achieved. So it's very important, therefore, for you to understand, okay, when investing in a cyclical stocks, okay, to study its financials so that if you are buying at the near bottom, okay, you would want to study the financials and so on to ensure that, you know, if the performance is good, you want to extend your holding period. So as you study the financials and as the company gain and its performance beat expectation, you want to hold the stock even for a longer period. But to do so, okay, it doesn't mean you hold it blindly. You need to study the economy cycle. You need to study the financials as well. Okay. So how to identify a cyclical stock? Okay. Now during an economy upcycle, consumers have more disposable income and will have a tendency to spend lavishly on non-essential items. Okay. This means non-essential items are like, you know, dining, fine dining, buying nice clothes, okay, going to, you know, instead of going to your neighborhood kopitiam, you go to Starbucks, you know, Coffee Bean, or you go to the cinema more often, you shop more often, you spend on luxurious products, okay, you buy luxurious cars, okay, you will tend to overextend your consumption at times. Now, during a down cycle, consumers will have lesser disposable income and would have a tendency to save more than spend. Their spending would focus on necessities instead. As I explained, necessities are like the things like clothing, okay, but not the luxurious type because we still require clothing, okay, on food that is necessary, okay, your daily staple and food that you cook yourself rather than dining out, okay? And therefore, cyclical stocks are often associated with companies offering discretionary products and services. Now, these are companies that offer luxury and lifestyle brands, including apparels, jewelry, watches, home decor, etc. Okay, including those high-end cars as well, okay, like the Merc, BMW, Audi, and such, okay. So travel-related business, including airline, hotel, and gaming industry. Now, if you have extra income, okay, you may want to spend more to travel, okay, staying at a better hotel, okay, and those who are of non-Muslim and also eligible age, they might want to go and gamble. This is called the gaming industry. Yeah. So fine dining restaurants and alcohol-related beverages. Okay. Now, festive and holiday season could impact upon. Yeah.
I thought alcohol-related beverages are more defensive because, like, good time people drink beer, bad time people also drink beer.
But actually, that time people actually would consume less. By alcohol, not like your normal brand, brand of Carlsberg and all those. Those I mean like the premium beers,
whiskey
okay,
type
whiskey type, okay, and brandy type, okay. Yeah, you know, people may drink more cheap beer, okay, maybe like those Carlsberg and Tiger so more.
Carlsberg, Heineken can buy lah, defensive.
Yeah.
All right.
Yeah, they want to drown in their sorrow. Okay. Yeah. Festive holiday season could also impact upon stocks of companies involved in retail, travel, hotel, and gaming. Okay. For example, investors may anticipate an outperformance, okay, by Genting Malaysia during the Chinese New Year period. Okay. And therefore, you know, some people, they anticipate that, hey, the economy cycle is good. Chinese New Year is around the corner. So I'll be anticipating that Genting Malaysia could actually deliver a good set of results post Chinese New Year. So before Chinese New Year, I may want to buy some shares of Genting Malaysia, let's say, for that investor who have that kind of thinking. Okay, or investors may anticipate an outperformance by Padini Holdings during the year-end sale period. So I know that every year-end there's always sales, that's Christmas season, and also the festive season like Chinese New Year, Christmas. So or even let's say towards the mid-year sales and all those, there's always Hari Raya coming in the next few weeks or month. Okay, or a month. Then people will anticipate, hey, retailers may be doing fine, especially those in the clothing industry. So people may want to buy into those company stocks. Okay, but however you want to anticipate the performance of this kind of companies, it is important to gauge the existing economic climate, okay, before investing in anticipation of seasonal demand, as it could influence the consumer spending in these areas. So it doesn't matter if the economy is on a downtrend during Chinese New Year, people wouldn't want to spend as lavishly as they want. Yes, they may want to try their luck more when the economy downturn is during an economy downturn, because it's a means to riches, let's say, and they want to bet. Okay, but then they might want to cut on other kind of expenses. So it does not necessarily mean that, gaming companies are recession-proof in the sense that people will want to gamble more. No matter what, in an economic downturn, people will actually reduce, okay, their consumption because their disposable income is affected. Okay. So periodic changes in the weather can affect the production of agriculture crops. Drought and inclement weather can damage crops, while seasonal changes such as the El Nino effect can lower the production of palm oil plantations, hence pushing the price of the commodity higher. Bumper production in the ideal weather condition could also pressure the price of the commodity lower. So here we have, this is an example of the El Nino and palm oil price. This is the El Nino period up to 2015, since 1951. Okay, but this is based on the 10-year chart. Yeah, and you can see that during the moderate El Nino, 2009-2010, which is somewhere here. Okay, it sort of affected the harvesting of the palm oil, and subsequently you see there's an uptick here. Okay, during this period. Okay, and there's an uptick in the price. Okay, similarly, in 2015 to 2016, there's another uptick. Okay, but El Nino may exert some influence, but you can see that the performance of plantation companies will be driven by demand much more, okay, than the weather effect. Also, it does not reflect so much on the plantation stocks, because I think a lot of the Malaysian plantation stocks, they actually expanded their base here to a degree that whether it's El Nino, although it can impact upon the harvesting, but right now their acreage, okay, the number of acres that they have in their plantations, okay, is much higher, and therefore they were still able to deliver a good harvest versus a fixed acreage. Okay, so that's why you can see that plantation companies are just continuing to expand their acreage, okay, by planting more, and also by phasing out the older plants, okay, with newer ones, so that they are much more prepared for cyclical changes in the weather. So that's why I think right now the impact of El Nino, although may impact the price, but overall it doesn't impact so much on the share price of the most of the Malaysian plantation companies. So another way to identify is when the price of raw materials rise, companies involved in extraction of these resources will increase their investment in new projects, thus causing an oversupply of raw resources, resulting in falling prices. Now, the best example is actually the oil industry, okay, where the overproduction of oil caused oil price to collapse in late 2014. Now, the collapse of oil price is very primarily driven by the overproduction, especially from the U.S. shale oil evolution, because previously U.S. production is not so high, but then when they started the shale oil evolution, they are able to deliver much higher oil production, because the shale oil extraction is very different from the conventional oil. Okay, for conventional oil, you will drill a pipe down to the oil bearing area. Okay, and then the pressure, because it's driven so deeply inside, the pressure underground would force the oil out, and it's through that one single pipe. Okay, but in shale oil production is very different. They will drill, okay, they will drill a hole, okay, into the ground, but then they use the latest technology where that drill bit is able to move horizontally. So they continue to drill horizontally so that you know, you have a singular vertical pipe into the ground, but then you have a spider web of pipes, okay, inside the ground underneath. So what they do is that they will inject the stones inside with some chemicals and water, so that it expanded the rock and therefore releasing the oil. So simultaneously, the oil will flow into this spider web of oil, of pipes, so that their delivery of per barrel per day is very huge. So for shale oil, they can, let's say, during the initial stage, the oil flow would actually be maybe 5,000, 6,000, or 8,000 barrels per day. But then because it's on a lateral basis, on a spider web basis, okay, the pressure would start to diminish, okay, and then their flow would actually drop very, very huge, okay, by about 50% after a year, then another 30% by the second year. So that's why all the US companies keep on, you know, drilling more and more, and as they drill more, the production keep on moving up, and that is why it caused the overproduction of oil. And not only that, a lot of the countries that rely solely on oil for income, you know, to shore up their finances, they are also increasing their output. So that's why, okay, you have we have an oversupply, a glut in the oil, okay, in crude oil, and therefore with OPEC not wanting to cut production at that time, the oil price collapsed. So these are actually man-made boom and bust cycle, and they can last for long periods of time until the equilibrium between demand and supply is restored. So even until today, okay, OPEC came out and said that, hey, you know, we are going to cut production. But then the US jacked up their production, and then oil price went all the way up to $55 per barrel, then dropped back down to 40 plus. But right now it's moving up again because there's a pickup in demand. And not only that, some US-based companies, they realize that if they continue to produce more, oil price is going to be depressed further, and therefore a number of companies in the shale oil industry, they are actually cutting down their capex. Okay, capex means capital expenditure. They are reducing their investment. Okay, so in order to stabilize the oil price. Now, these kind of things doesn't matter whether it's oil. It can also happen to, let's say, companies that involved in the mining industry. For example, there were overproduction of iron in the global market, and the price of iron fell. Okay, then price of copper fell, and then the commodity, most of the commodity enters into a bear market. So this is showing a relationship between Sapura Energy and the oil price. Okay, you can see that oil price reached a peak of more than 100 US dollars, okay, before the collapse. And then right now, having collapsed about close to 50%, yeah, of its peak. Now the bear market for oil is about 2.5 years, okay, of bear market. And similarly, you see Sapura Energy after the collapse, okay, somewhere in late 2014, it has continued on the downtrend. There was a slight pickup over here because oil price went back up to about 55, then dropped again because oil price was back to the 40s. So in this 2.5 years of bear market, you can see that Sapura Energy never did quite reach back to its peak of 4 over ringgit. Yeah, it's still about more than 50% discounted right now. So whether you should buy into Sapura Energy or not, I leave it for you all to do your due diligence. But if you want to have an indication, okay, whether you should buy into Sapura Energy because the share price have been so greatly depressed, okay, you look for a few things. One is that you have to look at the company after all this depressed in the oil industry. How does it impact their financials? Are their financials very strong? Are they too heavily in debt? Okay, or are their debt level manageable so that you can actually see that decide whether this company has the financial strength to survive an extended period of the bear market. Now, the other thing that you should look out for is the US dollar. Okay. Now, if let's say US dollar actually has fallen about 10% yeah, since reaching its peak in late December last year. So that time was about, the index was about 103. Right now it's at 92 something. So the index actually have fallen by about 10%. Now, if continued weakness in the US dollar happens, okay, and the US dollar weaken even more, you can see that the price of oil could be moving up, okay, because commodities, most of the commodities are priced in US dollar. If US dollar is weak, okay, people who supply the commodities would want to see that their revenue is not affected, and therefore they would actually demand higher US dollars for their product. Okay, this is what happened. Okay, why oil actually moved up to about 100 over dollars. Okay, when it was let's say during the crisis area, okay, it was about 40 plus dollars. What happened was that the Federal Reserve started printing money through QE1, 2, and 3, and caused the US dollar to weaken. When the US dollar weakened, okay, then the price of oil starts to pick up. Okay, so if you want to buy into any of Malaysian companies that are associated in the oil industry, look for further weakness in the US dollar. And if let's say the US dollar trend continues to fall, then oil price will actually pick up, and therefore you will see that the company shares could move up because right now they could demand more, okay, for their type of services. Yeah. So strategies in buying cyclical stock investment. Okay, this portion we'll talk about buying. Okay, now everyone of course is familiar with buying low and selling high. Okay, but you never know how low it will be. Okay, neither would you know how high can it go. Okay, so it's not as easy as it sounds, as it is difficult to predict the bottom. Okay, best strategies to adopt: don't predict the bottom of the bottom for the stock price. Okay, we never know in an economy down cycle how low can it go. That is why I don't normally advocate. This is just my opinion. Okay, my opinion may be different from other people from that you have heard from. Okay, now I don't normally agree to average down. Okay, simply because you do not know where is the bottom. Okay, if the price continue to fall, you continue to average down, then you're committing even more capital into a stock that is continuously falling. So I don't normally advocate average down. Okay, and if let's say, unless the company financials is very, very strong, they can ride it up. Okay, and even if that company is strong, okay, you have to wait until that price is it's very much away from the from your original purchase price before you want to average down, and that also depends on the possibility of that company having a further potential for future growth. Okay, so don't simply average down because you never know where the bottom is. The more you average down, the more you commit your capital on the same stock that is not performing. You might as well use your capital to invest in other stocks that are actually performing. So don't simply average down only when that company has the potential to come out of it, okay, stronger, okay, and better because other competitors are just phased out, okay, and also must have strong financials, okay. So this is my opinion only. You can follow what I say, or you can use your own judgment, okay, to gauge, okay. So the other thing is, look at the economic cycle first, okay. Once the bottom is reached, okay, allow 3 to 6 month time for confirmation that the economy is once again growing. Need to change this. So we will never know the bottom, and once the bottom is reached, okay, we also wouldn't know unless that the upcycle has started to show signs, and only then we know that, okay, we have passed the bottom. So you would never. It's very difficult to buy at the bottom, but certainly if you follow the economic cycle, you will buy at the near bottom, okay. So normally I would buy, okay, after the crash, and I will allow 3 to 6 months to see where the economy is going, okay. If let's say the 3 to 6 months affirm my belief that the economy is once again growing, okay, then I would commit a purchase because I finally have more confidence that the economy is on stable ground and is now on an uptrend, okay. I precisely use this strategy, okay, in buying a stock, okay, but that was a US stock when the US market crashed, okay, and I'm able to have 700% gain just after 2 to 3 years, okay. So that is when you buy near the bottom, okay. So don't predict where the bottom is, but know that when the economy is on an uptrend, okay, you are able to buy into that stock, okay. Then look for stocks which are likely to gain first in the early upcycle. Now, for example, once confidence returns to the economy, consumption by consumers would tend to pick up. Then, okay, you would know what kind of stocks to buy. Okay, for example, if consumption starts to pick up, okay, then I would buy into strong retailers because economy upcycle is now on steady ground. Okay, people would have confidence and people would consume more. So I would buy into those retailers. Okay, certain those maybe in the travel industry, okay, or hotel industry, okay, and those would be those that are able to perform better, and those consumer products that are more lifestyle related, those would most likely perform better as the economy picks up steam. Okay, then you need to measure the performance of this company to ensure they are showing signs of growth. Some companies, even though the economy have recovered, but their pickup in pace is very, very slow. So you might want to give these companies a miss first. Okay, study them, keep them in view, but don't commit a buy. Only select those companies that, for example, in the first quarter report after they come out from the, trial of the economic cycle. Okay, the first quarter, the first quarter report that you see moving away from the recession, okay, has double digit growth, then this company is something that you may want to invest in. Okay, so similarly, during the Nasdaq bubble burst, I bought into a number of Bursa stocks as well. Okay, that was the stock market, the Nasdaq bubble burst in 2000. I started buying them. Not very, sometime in 2002, 2002 and 2003. Okay, then I managed to exit some. Okay, especially those plantation stocks. I exit some with almost 100% in profit. Yeah. So always take opportunity of cycles. Okay, because those are the period where you can really buy very low. Okay, and then as the economy gain traction, you are able to sell into the strength of the economy and therefore make multiples of gain. Okay, so identify companies with the best potential returns, buy selectively. Okay, it doesn't mean that, you know, when the stock markets have gone bust, okay, because of a huge recession, okay, and a lot of the stocks are now very, very cheap. You tell yourself, I can buy any, you know, and they will sure go up. Yes, some may go up, but some may even go up exponentially higher. So you want to select those that can grow at an exponential rate. Okay, not those that will maybe 20-30% and that's it. You want to buy those that, you know, the first year give you 20-30, the second year, okay, give you another 50, then the third year another 20-30. So that when you see now, if it first gained by 20%, second year it gains by another 50%. Now that's a lot, you know. It's like 1.2 times 1.5, okay, and you know, then it becomes like, you know, like so-called compounded rate of return, okay, for your stock. So that's why be selective. Okay, select those companies that are strong so that they are and best potential to recover, so that you have the right stock to buy. Now the selling, well, for trading, it's very important to set your own price targets. In an upcycle, okay, do have multiple price targets depending on your level of risk acceptance. For example, you know, you may want to exit at gains of 30, 50, 100%, etc. You know, of your original purchase price. Okay, you set a target. Okay, and each time you sell a portion of your holding. Okay, so that, you know, in normally, if let's say you are investing in a stock, okay, and you really, that stock have a history that normally in upcycle it can grow very strongly. Okay, then when you are buying near the bottom, of course you wouldn't buy, let's say, a small portion. You want to buy a big portion. Okay, and if you are able to buy a big portion and your capital allows you to hold, okay, then you can trade at different levels of price increase, so that, you know, each time you are able to trade at and exit at different price targets, you are able to commit your capital onto the next growth stock. Okay, so for traders, these are the things that, you know, you need to set. Okay, so that you know when to exit at certain price levels, and each time you sell a portion of your holding. However, it still requires you to monitor quarterly results and sell into strength. Okay, now for a long-term hold, and you want to extend your period, your holding period, whenever the company performs above market expectations. Okay, like if you look at Padini, you know, if you have held it for 9 years, okay, you know, it's 900% when you have bought near the bottom. Okay, so it requires you to monitor the quarterly results and economic data consistently. Why? Because each of the quarterly results of overperformance or performance to market expectations and economic data that shows strength in the economy would reinforce your confidence that the stock will be able to ride higher. Okay, now, but when to sell? Well, you can sell when there are early signs of the growth stalling. For example, that company may be growing at double digit, you know, 20-30% initially, okay, when it's coming out of the recession. Then the next year also 20-30%. But there will come a time when near a certain peak, you know, the strength of growth will no longer be 20-30. It could show signs of 15, okay, 10 to 15. Then you may want to tell yourself that, okay, if it drops to single digit, I want to sell. Okay, because it means that that company may have expanded to such a big degree, okay, that, you know, lean company coming out of recession normally have fantastic growth. Okay, but then as they expand, the baggage becomes bigger. Okay, that is why, you know, you have those very, very high cap companies. You don't see them growing 30-40%. okay, they will grow by strong single digit or low single digit because, you know, they have become so big, you know, there's so many departments and unless they trim down, okay, then otherwise, you know, their growth would actually tend to stall. So, when you see these signs of the growth stalling, then, you know, it's time for you to exit, okay? And then you will have a very nice and tidy profit. Okay, the other thing is that, you know, sell on the early signs of economic weakness. By economic weakness, I don't mean that you sell only when the, you know, the economy, instead of growing, you know, in positive, you know, suddenly you have negative growth. No, by that time it's already too late. When certain signs of economic weakness, early signs normally they come in the form of, let's say, weakness in the export market. Okay, for example, Malaysian exports are trending down. Okay, now these are the first signs that tells you that, hey, you know, because Malaysia export a lot of goods. If let's say the export is falling down, means that the global market could be slowing down. Okay, and therefore these are the first few indicators. Then the other thing, okay, if let's say there are certain reports out of the retail sector that shows that you know, retail sales is actually stalling. You know, last they were growing at 10%. Let's say now it's growing only at 5% or 6%. These are the signs. So these are the signs of weakness, but it has not gone into a full-blown recession, because if you sell during a recession, that stock would have actually trimmed, you know, 30% or 50% of its peak, its price at the peak. But if let's say you are selling, okay, just as the indicators are not full-blown recession yet, but indicators are showing some weakness, most probably you could be about 10 or 20% away from the peak. It's not too bad. Okay, so it's better to be slightly away from the peak than selling after the peak, where then the price could actually fall, you know, 20 or 20, 30 or even 50%. Okay, then the other thing is that you can also sell when you achieve your target price. For example, you may want to have a very high target because based on historical patterns. Okay, you can say that, hey, if let's say next recession comes, okay, then I would set, you know, my price, let's say for Padini, I would set it at 800% profit, or because previously it has gone out, you know, up to 900% profit. Then you may say, okay, I exit when it achieves 800. Okay, so these are the kind of things that you can consider. Okay, and each time you need to evaluate your strategy. It doesn't mean that, you know, you fix your selling price at 800% and therefore whatever happens you don't care, you know, and just wait until it's no. You need to study the quarterly results, okay, and economic data consistently, so that any indication that that company may have certain growth potential, then you may want to up your exit point, okay? Or that certain that company may be a certain company may be borrowing more money for that expansion. Then that might raise a red flag, because after they announce that they are buying more bonds, they are selling more bonds to actually have more money to expand, but then their debt to equity ratio suddenly bursts to your own KPI. Okay, then those are the signs that you may say that, okay, I better trim down my expectation and I may want to exit a portion first just to be on the safe side. So these are the things that you need to consider, okay, if you're holding for a long-term period, because you are not playing on a cycle of, let's say, you know, 2 to 3 years. Okay, you are playing on an extended cycle of, you know, between 5 to 8 years or even 9 years for that matter. So that's why you need to be more actively looking at the economic data, the quarterly results, look out for the company announcement, measure the financial strength of the company consistently, so that you are able to either project a higher profit moving forward, or you scale down your expectations. So these are all I have. Now to the Q&A